Critical Mountain Pictures presents the 4X video training series. Blue Belt course, Introduction to Elliott Wave. Back in the 1920s to 30s, there was a mad genius and professional accountant named Ralph Nelson Elliott. By analyzing 75 years worth of stock data, Elliott discovered that stock markets, although thought to behave in somewhat chaotic manner, actually didn't. When he hit 66 years old, he gathered enough evidence and confidence to share his discovery with the world. He published the theory in the book entitled The Wave Principle. Before we get into the details and operation of the Elliott wave, you need to first understand what fractals are. Basically, fractals are structures that can be split into parts, each of which is a very similar copy of the whole. Mathematicians like to call this property self-similarity. You don't need to go far into fractals. They can be found all over nature. A seashell is a fractal. A snowflake is a fractal. A cloud is a fractal. Fuck, even a lightning bolt is a fractal. So, why are fractals important? One important quality of Elliott waves is that they are fractals. Much like seashells, snowflakes, Elliott waves could be further subdivided into smaller Elliott waves. Mr. Elliott showed that a trending market moves in what he calls a 5-3 wave pattern. The first 5-wave pattern is called impulse waves. The last 3-wave pattern is called corrective waves. In this pattern, waves 1, 3, and 5 are motive, meaning that they go along with the overall trend, while wave 2 and 4 are corrective. Do not confuse waves 2 and 4 with the ABC pattern that will be discussed later. Let's first take a look at the 5-wave impulse pattern. It's easier if you see it as a picture. We have color-coded each wave along with its wave count. Short description of what happens during each wave. We're going to use stocks in our example, since stocks is what Mr. Elliott used, but it really doesn't matter. It can be used as currencies, bond, gold, oil, or tickle me Elmo dolls. The important thing is that Elliott wave theory can also be applied to the foreign exchange market. Wave 1. The stock makes its initial move upward. This is usually caused by a relatively small number of people that all of a sudden, for a variety of reasons, real or imagined, feel that the price of the stock is cheap, so it's a perfect time to buy. This causes the price to rise. Wave 2. At this point, enough people who are the original wave consider the stock overvalued and take profits. This causes the stock to go down. However, the stock will not make it to its previous lows before the stock is considered a bargain again. Wave 3. This is usually the longest and strongest wave. The stock has caught the attention of the mass public. More people find out about the stock and want to buy it. This causes the stock's price to go higher and higher. This wave usually exceeds the high created at the end of wave 1. Wave 4. Traders take profit because the stock is considered expensive again. This wave tends to be weak because there are usually more people that are still bullish on the stock and are waiting to buy on the dips. Wave 5. This is the point that most people get on the stock and most driven by hysteria. You usually start seeing the CEO of the company on the front page of major magazines as Person of the Year. Traders and investors start coming up with ridiculous reasons to buy the stock and try to choke you when you disagree with them. This is when the stock becomes the most overpriced. Contrarians start shorting the stock, which starts the ABC pattern. The extended impulse waves. One thing that you need to know about the Elliott wave theory is that one of the 3 impulse waves, 1, 3, or 5, will always be extended. Simply put, there will always be one wave that is longer than the other 2, regardless of degree. According to Mr. Elliott, it's usually the 5th wave which is extended. As time went by, this old school style of labeling has changed because more and more people started labeling the 3rd wave as the extended one. The ABC correction. The 5-wave trends are then corrected and reversed by 3-wave countertrends. Letters are used instead of numbers to track the correction. Check out this example. Just because we're using a bull market as the primary example doesn't mean the Elliott wave theory can work on bear markets. The same 5-3 wave pattern can look like this on a bearish market. The types of corrective wave patterns. According to Mr. Elliott, there are 21 corrective ABC patterns, ranging from simple to what the fuck over. 21. You can't possibly memorize all that. The basics of Elliott wave theory are not that difficult once you sit down and take a look at it. Let's take a look at some of the normally occurring formations. Zigzag formations are very steep moves in price that goes against the predominant trend. Wave B is typically shortest in length compared to waves A and C. These zigzag patterns can happen twice or even 3 times in correction. 2 to 3 zigzag patterns linked together. Like with all waves, each of the waves in the zigzag patterns could be broken up into 5 wave patterns. The flat formation. Flat formations are simply sideways corrective waves. In flats, the lengths of the waves are generally equal in length, with wave B reversing wave A's moves and wave C undoing wave B's moves. We say generally because wave B can sometimes go beyond the beginning of wave A. Triangle formation. Triangle formations are corrective patterns that are bound by either converging or diverging trend lines. Triangles are made up of 5 waves that move against the trend in a sideways fashion. These triangles can be symmetrical, descending, ascending, or expanding.